It's time for the Your Personal Bank Show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank in Formation. Take charge of your financial future with Your Personal Bank. Now here's Ferenc Toth.
Personal Bank Show. So I'm going to delve into a subject matter that typically has a lot of controversy associated with it, especially in the financial world. We'll put it that way. Of course, we're the Your Personal Bank Show. We talk a lot about your personal bank concept, which, of course, what that is. If you haven't heard, I'm sure if you have, of course, you understand. We're using a high cash value insurance policy. This is not the type of policies most people are familiar with. These are policies that grow cash, maximize cash growth. We have companies that have been paying 6% plus dividends for 25 years plus, never missed the dividend since before the Civil War, literally. So again, these are long-term high dividend payers. Okay, A+ rated, all that good stuff. Then we combine that with a bank line of credit, of course. And we have banks that will use the cash in the policy as collateral. Bank line's currently 3%. So if you're earning 6 and you access the funds through the bank line and you're getting charged 3, what's your money doing? It's pretty obvious. Your money's still growing. So one of the things I tell people is, hey, it's pretty cool. You put the money in there and you're going to get credited, based on the last 25 plus years, 6% returns, dividends. If you access it, use it to pay bills, invest in other things, still pick up 3%. And, if you use it for another investment, think about how would you like to add, 3% returns on your investments, for example. This is a great way to do it. But what I want to talk about today, like I said, one of the things I like, one of my purposes and goals for this show really is quite simple, and that's to try to cut through the noise. Those of you that have been listening since, particularly when the COVID stuff came up in March and beyond, there was a lot of stuff going on, a lot of information flying out there. And one of the things I tell people often when I'm working with clients and talking to them and things like that is, you got to be careful when you're reading articles or financial articles, experts, whatever. Does this information pertain to you and your situation? Often it doesn't. Okay. And that's what's so important and critical when you're looking and listening to these types of things for advice. So again, trying to cut through the noise on what some of these things. And one of the things I want to cut through the noise on, and this is, I find very interesting, is, annuities have gotten a bad rap for a lot of years. And in fact, there's an article here. We're going to post it on our website, and it's, at yourpersonalbank.com, so you can check it out anytime you want. But like I said, the name of the article is Annuities Have Long Gotten a Bad Rap, but retirement experts now say savers should consider basic options for guaranteed income. This is an interesting article. It's I think it was in Barron's, if I remember right. I found it, and it was written very recently. The key is, the point that they're making about this is most people, when they're doing retirement planning as such, they're looking at stocks and bonds, in their portfolio, and whatever mix makes sense, what's appropriate. We've talked a lot about the ratios and what's recommended, depending on someone's situation. Again, that can vary. But like I said, the point in this article is it states here, instead of thinking of retirement as stocks and bonds, think about retirement as stocks and annuities. And the reason this is coming up, and there's several more articles. There's a Kiplinger article, 10 Things You Must Know About Annuities, Reevaluating Today's Safe Money. It seems like there's a whole slew of articles suddenly this week that have come out, well, frankly, very positive towards annuities. And I find that interesting. I've been dealing with them for 22 years now myself with clients. Various types, but the reason that all these articles are alluding to is the Fed, the Federal Reserve. Basically, the Fed is virtually guaranteed a low interest rate environment for the next 2.5 years, if not longer. If you haven't heard, about a month ago, the Fed came out and basically stated they're going to keep the current low interest rate environment through the end of 2022. So that gives us 2.5 years from this point of extremely low interest rate environment. Now, if you're looking to refinance a house or your borrowing costs are lower and things like that, that's great for those kinds of things. But when it comes to looking at trying to get a return on investment or a steady return, income, interest income, those kinds of things, it gets really tough. And we're like all these different articles. Like I said, we'll post a couple of them, a couple of the better ones on yourpersonalbank.com, so you can check it out, read it, pass it on, whatever. But the key is the bonds, based on are highly affected by interest rates. So they're really the returns are getting pushed down. And it's getting harder and harder to find, some type of income sources, steady, consistent type of income. As the articles talk about, part of the reason why annuities have gotten a bad rap, and like I said, I've dealt with them with clients for 22 plus years. I have many, many clients who have used these over those last couple decades very successfully with great results. And here's the situation that I run into probably more than any other, is when I run into somebody and say, hey, maybe you should consider or have you considered an annuity? And if I get a negative response or negative reaction, it typically, and then I'll ask some questions to determine why those feelings are there, why that response is there. And I'll get things like, well, I've been told they're bad, or I've read that they're bad, or, stay away from annuities. And there's some people that have built their whole careers out there. We know some of you know who they are. I'm not going to name any names to cause any problems with anyone. But we know there's people out there that have built their entire career, their entire business off of basically bad-mouthing annuities and other financial products. And one of my statements I talk about all the time that I point out with folks is this. There are financial tools financial tools are not good or bad per se. Financial tools, just like any other tool, is designed for a specific purpose or a specific job. I always use the example of a hammer and a saw. If you're trying to cut a piece of wood, which is the better tool? Which is more efficient? Most everyone understands you'd rather have a saw. If you want to drive a nail, do you want a hammer or a saw? Again, the hammer is going to drive the nail much more efficiently than a saw. Why is that so important? It's not that the hammer or the saw is good or bad. It's that they're designed for a specific job. So what I do, and just like financial products, financial tools basically operate the same way. In other words, it's not that they're good or bad. They're designed for a specific purpose. So what I do find quite often, very often, is somebody will, talk with them and look at their situation and figure out their financial needs and goals and various things, what they want. And then I'll look at their investments, whatever it is they're in, and I'll see a dichotomy there. I'll see, you're telling me you want this, you want A, but yet they're basically invested in B, or much of their investments are in B. You see what I'm saying? So I started asking some questions about why did you do this? What's your goals here? What did you want to accomplish? Sometimes it's a situation where their financial goals were different when they purchased those particular financial tools. And now their life situation has changed. Maybe they've moving into retirement or various different things. Life situations occur. Okay, started a business or lost a job or any number of things may have happened to them. Because we all have different life stages, of course. But most often, that happens sometimes. And of course, we readjust their financial tools to fit their current goals and needs now. But what I find, frankly, far too often in my 22 years in this industry is they tell me they want A, and yet they're invested in B, and I ask why, and they say, well, that's because that's what someone told them to do, or they read somewhere that they should do this, or whatever. So then I start asking some questions. I'll say, well, this product, this financial tool that you're currently invested in, this is what its strengths are. This is what it's designed to do. And I'll list whatever the 2 or 3 or 4 strengths are and the limitations of that product. And I'll ask a simple question. I'll say, does that sound like that fits your goals? And invariably, obviously, the answer is no. So annuities are not bad. Annuities are not complicated. There are certain ones that have different factors or riders or options that might add to some complexity to it. But when you're talking about basically annuities really are designed for a couple of different things, okay? Primarily they're designed for growth. Okay, if you're talking about a fixed index annuity, that's what it's designed for, growth with safety. In other words, you invest in an index, some of the most popular indexes, can make double-digit returns on good market years with no loss in the down years, okay? Or you have an income annuity. These are guaranteed lifetime income payers. In other words, they're designed to pay a certain payment. There's another type of annuity out there, variable annuity, designed for growth. Okay, it has market risk, but it has some tax benefits. So again, that was designed for more of your person's high income earner, able to take on some risk and want some tax benefits. It's not that it's good or bad, is the fit right for you? Stay tuned in the next segment. I'm going to talk more about these and these articles and why folks should start really seriously considering annuities for income instead of bonds. Stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We're talking about something a little bit different today. Normally, again, we talk about your personal bank, how we can create positive arbitrage using high cash value policies combined with a bank line of credit, where you can create 2-3% positive arbitrage on monies to help you reduce borrowing costs or enhance investment returns. But today, again, I want to talk about something a little bit different, and that happens to be, and it's a controversial subject in the financial world, and that is annuities. And the reason I'm bringing this up is it's interesting. There's a whole slew of articles that have come out this week from Barron's, Kiplinger, and various other sources talking about using, and they're overwhelmingly favorable articles, by the way, which is interesting because it's kind of unusual. Annuities tend to get a bad rap. And in fact, one of the article titles of one of the articles is, in the Barron's article, is annuities have long gotten a bad rap. Retirement experts now say savers should consider basic options for guaranteed income. And the article, we'll post it on yourpersonalbank.com so you can check it out or pass it on. But it's kind of interesting is they're now talking about, like it says, this advice about using stocks and bonds in your portfolio, and the bonds kick off income while the stocks provide growth. This advice looks like it needs of a refresh. And the reason behind all these different articles and why they're saying it makes sense for folks to start looking into annuities, income annuities in particular, by the way. There are different types. We'll talk about that further in a minute. But why folks should start considering income annuities is because the bonds interest rate environment with the Federal Reserve has basically virtually guaranteed an extremely low interest rate environment, at least for the next, through the end of 2022, if not beyond that. So this is going to cause returns on bonds interest rates to struggle, okay? Annuities have an advantage over that, income annuities that are. Now, by the way, before we talk about that, when I say annuity, and I talked about this in the first segment quite a bit, there's a lot of angst or misunderstanding or folks that get emotional or have heard they're bad, various other things. Like I said, one big hurdle to the widespread adoption of annuities is their reputation. It says many consumers and financial planners shun them. And there's folks out there, as we know, who've built whole reputations and businesses on saying annuities are bad. And like I said, there's bad fits, but there's not. The financial tools have specific purposes. There's really 3-4 different types of annuities out there. And you have the variable annuities, which is typically based on an index. They have they have the upside potential of an index with a downside market risk. So high risk, high reward. Okay. They have tax benefits, okay? So somebody who is a high income earner can handle some risk. A variable annuity can be a fit for that person. Obviously, if you're not in that mold or that's not your situation, probably not the best fit. There's index annuities out there, which are quite popular and have become more and more so. Actually, I was one of the early adopters in the index annuity world. Started offering those to clients, back in 1997, I believe, 1998, something like that. And they were the index annuities offered to the private sector. I think the first one was 1995, so it was very early. But the thing is, the advantage of an index annuity is for someone who wants to still capture some upside potential growth. Usually it's based on the S&P 500 up to a cap, up to a certain amount of growth per year, but eliminate the downside market risk. So the floor or the principal is guaranteed, okay? So for someone who wants some growth with some safety, an index annuity can be a good fit for that person. Then there's the income annuities, or income riders, I should probably say. See, a lot of these products have a rider where you can basically set up a certain amount of guaranteed income guaranteed for the rest of your life, or you and your spouse. Okay. And then the numbers are based on how much you contribute, of course, and your age. It's an actuarial calculation. Obviously, the older you are, or the longer you defer that payment, you have total control of those payments, the more money you get. And so it really satisfies the income need of what a lot of people use bonds for. Ultimately, they're using those as part of their portfolio to create income to supplement retirement. That's the most common use. And an income annuity can do the same thing. And by the way, they have very low fees and costs. And that's where a lot of the confusion comes in, is when somebody says annuity, it's really such a broad term. You really need to ask the question, this help people understand this better. What type are you talking about? And some of these articles, some of the articles these are all favorable pretty much. But, in the past, they would lump them all into the same boat. And it wasn't true. It wasn't accurate. I'll put it that way. It wasn't accurate in terms of different types. The income annuity is the one that really can shine, like I said, in terms of creating income for somebody to supplement retirement or whatever in lieu of bonds. And that's what all these articles are really alluding to. In fact, this one article, like I said, we'll post it on yourpersonalbank.com from Barron, says, look, instead of thinking retirement as stocks and bonds, start thinking about retirement as stocks and annuities. And here's the reason. If you take an income annuity, we're going to dive into this a little bit. I always tell people, look, there's 3 major reasons I see most often that people purchase an annuity. And by the way, people do it by the billions every year in the U.S. Don't let anybody fool you. There's a lot of folks out there purchasing these products, irregardless of what we hear or are told. I mentioned this earlier. The variable annuities for that high income earner can handle some risk, wants or needs some tax reduction of taxes. Okay, they need some tax benefits. That's a fit for them. Then you've got the index annuity person who still wants some growth, some potential growth with the downside risk eliminated, so they won't lose. And those can be nice for somebody who still wants to do some of that. And then there's the income annuity. And that, again, it's really simple. You tell me your age, you tell me the amount of money, and then there's a spreadsheet that comes out, and we compare to all the different companies out there. Don't just look at one company. You're doing yourself a disservice if you do that, particularly in the income annuity world. You want to compare against basically all the major A-rated companies. You want to have a good, solid company that's going to guarantee an income. And based on the amount and your age, and then the age of you start distributions, it's a spreadsheet that'll come out and tell you you're going to get X amount of dollars per month. The returns coming back to folks can be in the 5-6% range. Okay? These are guaranteed lifetime income annuities. Okay? What does that mean? It means you're going to get a check every month for the rest of your life, if that's the option you choose. Or you can choose an option for you and your spouse. So much like a lot of folks who retire with pensions, or when they sign up for Social Security, for example, there's a number of different choices of how you take the distributions, how you take the payments. An income annuity has similar choices on the income. All right. So obviously, if you choose it on a single life versus 2 people, husband and wife, then the payment's slightly higher, just like with Social Security or a pension. If you take it for lifetime versus, say, take it for a certain period of time, you can choose, say, 10 years. You can choose 20 years or any number of scenarios. I want to get the income for X amount of years. The shorter the number of years of income, the higher the check would be each month, right? Obviously, the older you are, your life expectancy is shorter, so the higher the payout. You have total control. That's another thing a lot of people don't realize about these. Well, there's 2 options there too, so not to confuse the issue. There's an immediate annuity. That's where you turn on the income stream now, and you lock in, you make your choice, lifetime or certain number of years or joint life, whatever, and that's going to be your income check for your lifetime, no matter how long you live. So even if the funds deplete in the account to zero, you'll still continue to earn that income check. There's deferred income annuities, which work the same way, but the difference is you're deferring the payment. You're deciding when you want to start the payment. And one of the nice things about those is we call it turning on the faucet or turning on the income stream. You can choose when or where you want to turn that on. You can turn it on and off It's totally under your control. And then I guess the last thing I want to touch on this is one common misconception is when you start an income stream, and let's say you die prematurely. Some people think, well, you lose all the money. There are some options in there that's the case, but you can do what's called a lifetime with 10-year period certain. What does that mean? It means you're going to get lifetime payments guaranteed for the rest of your life, for the rest of you and your spouse's life. Again, whichever option you choose. You'll know exactly what that number is because there's no guesswork. All this stuff's guaranteed. That's what's nice. Remember, it's guaranteed lifetime income. You'll know what that number is. You can choose that number. You're going to have that much income per month for the rest of your life or the rest of you and your spouse's life with a minimum of 10 years of payments. What does that mean? Simple. If you happen to pass away, say at year 5, all the payments weren't made out, well, the remainder payments would go out to your heirs, which means your principal, what you contributed, would get paid out to either you or your heirs, so the money's therefore not lost. So there's simple ways to accomplish these type of annuities. Like I said, I've been dealing with them for 20 plus years. And I'm not saying this to brag or anything. I've been one of the top 10 producers of some of the major annuity companies in the country. And so I've dealt with these for a very long time. I've also been involved with some of the, helping create some of these products. So stay tuned in the next segment. We're going to talk about a little bit more about this to give you a better understanding and, like I said, cut through the noise.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We are talking about something a little different today, and I normally have, sharing people with the personal bank concept, how that works. As we said, go to yourpersonalbank.com, find out more information, listen to any of the previous shows. The personal bank concept is quite simple. It's you're taking a high cash value policy. This is a policy it's designed to maximize cash growth, tax favored basis. This is not the type of policy most people are familiar with. It's very, very different. And then we combine that or integrate a bank line of credit. Currently, we've got companies are paying 6% dividends, have for the last 25 years in a row, never missed dividend payments since before the Civil War, A+ rated, tons of cash reserves. These are long-term dividend payers. So if you're looking for a solid dividend payer, you really need to look into the personal bank concept. And then what makes it even better is when you combine that with the bank line of credit, which we have bank lines currently charging 3%, I always ask folks a simple question. If the money's in there and it's growing at 6, you leave it there, you're getting 6, right? Dividend. If you access the funds through the bank line, you're earning 6, you're getting charged 3, what's happening to your money? It's still growing. So even though you access the funds, let's say to supplement retirement, pay bills, invest in other things, whatever it may be, you're picking up that 3% positive arbitrage. I always say, how would you like to earn 3% on money you spent? Or how would you like to increase the returns on your investments by 3%? That's what Your Personal Bank can do. That's why we're so passionate about, excited about, and share it with folks. But today, I've been talking a lot about annuities. And I know for a lot of people, when I say that word, I can just envision it. Some people kind of cringe or whatever. And it's because the reason is annuities, frankly, have gotten a bad rap over the years. Now, the reason I'm bringing it up is it's funny. There's a whole slew of articles that have come out just this week, and frankly, they're all very positive. And it's like a whole shift. And I mean, I'm talking Barron's, Kiplinger, various other sources. We'll post some of these articles on yourpersonalbank.com so you can check them out, pass them on, whatever. But they're talking about annuities getting a bad rap, but retirement experts are now saying savers should consider these for guaranteed income. And the reason why, like I said previously, is the historically low interest rate environment. Bonds are struggling with this low interest rate environment in terms of generating interest or income. Annuities are in a better position to be able income annuities. Now, again, there's different types. We talked about that in previous segments. There's variable, there's index, there's deferred, there's income annuities. I'm mostly focusing on the income ones because, for one thing, they're very simple. 2, they're very low fee, low cost, okay? And 3, they accomplish the goal for most people that I talk to, and these articles talk about it here too, of what bonds formerly did for folks and probably are going to struggle doing for the next few years at least. Like they're saying in this article, instead of thinking of retirement as stocks and bonds, start thinking about retirement as stocks and annuities. Because annuities are going to satisfy, the income annuities, I should say, are going to satisfy those income needs of folks, well, what they need to supplement retirement. And like I said, the reason they're able to do that is they create a guaranteed lifetime income. There's a whole pool of folks the insurance company uses to enable that guaranteed income to come to you literally for the rest of your life if that's the option you choose. I'm talking about this because I've dealt with annuities for over 20 years. I've been one of the top producers in that over many of those years with some of the top companies. I've even been involved with a couple of different companies on their advisory boards in terms of creating these products. So I've worked with the actuaries and whatnot, the head actuaries, on helping create some of these products. Again, annuities are not good. Annuities are not bad. They're a financial tool that serves a purpose. And if you can get past that emotional response, because we've heard so many things, a lot of financial advisors say things are, annuities are bad, or a lot of things are written about annuities are bad, and they paint this broad brush, okay, which is sadly not always accurate and often inaccurate because there are so many different kinds of annuities that do different things. A variable annuity and an income annuity, frankly, in my opinion, they both shouldn't be called annuities, because they're so different of a product and they do such different things, and they're for such different types of situations. I mean, it's night and day difference, okay, on what they actually accomplish and what they're designed for and the type of person or situation that they shine or really do well with. I want to focus primarily on the income annuity, and you can do two different types. You can do an immediate or deferred. What's the difference? What I'm trying to do is cut through the noise a bit and just educate a little bit and help folks understand these a little bit better. Like I said, I've worked with the head actuaries on some of these, helping creating some of these products. And by the way, when you look at an income annuity, you should compare. You should compare amongst a number of companies so you know you're getting the best income available. Okay? Just like anything else, there's competition, right? So you want to compare amongst a number of different companies. And when you're looking at an income annuity, it's very, very simple. You should be able to get a spreadsheet. We create those for our clients. It's so simple, where literally we take the certain amount of income, the contribution. How much do you have to contribute? What's your age? And what's your age when you want to start the income? We can do it immediately or at a delayed rate or deferred rate at some point in the future. Based on that information, you'll have a monthly income number. And that number is guaranteed if you choose the guaranteed lifetime option, guaranteed for your life or you and your spouse's life. You can also set it for a certain number of years and various things like that. But most people are designing these and setting these up to create guaranteed lifetime income. What does it do? Well, several things. First, you've got an income source you know that you can count on. You know it's going to be there no matter what. It also is a longevity insurance kind of tool. In other words, we don't know how long we're going to live. That's an uncertainty in retirement planning that just can't be answered on an individual basis, can it? So each individual person has no idea really how long you're going to live. Having that guaranteed income source, Social Security is one source, pensions can be another, annuities can be a third source of guaranteed income that will not. You won't run out of money. How's that? You won't run out of that income if you choose the guaranteed lifetime income option, which is typically what we recommend, obviously. So my point is simple. You're replacing the bond, which is struggling with interest rates and returns because of the lower interest rate environment, with the annuity that can generate a higher return, a higher income to you on a guaranteed basis. Again, these are handled at very low fee, very low cost, and they're designed for that purpose. Common misconceptions, simple. People think that if they turn it on, they lose control of the money. There are some immediate annuity options that you can choose that is true, but that is the very rare exception. Most folks don't choose that option. You want to have somebody who's familiar with these tools and all the different options and the various companies, and they can show you the different options. And bottom line is simple. This is how much you'll get a month if you get this option. Choose this option. If you choose that option, this is how much you get per month. And many of them will, if you look at a deferred one, if you want to turn on the income in 1 year or 5 years or 10 years or whatever that may be, here's the amount you're going to get when you turn it on. Again, all of this is guaranteed. There is no guesswork. And that's what's so nice about it. And frankly, what makes it so simple. Literally, and we do this often, we can reverse engineer it. In other words, folks will say, well, I don't know how much I want to put in, but I know how much I'm going to need. So if someone says, I want $1,000 a month income, for example, or whatever the number is, it's not important. Based on their age and when they want to turn the income on, we can reverse engineer and tell you how much you need to deposit to create that income. There's no guesswork. So again, it eliminates the uncertainty of your income. It eliminates what are you going to get in retirement. It eliminates, am I going to run out of money in retirement, because you have these guaranteed lifetime income situations set up. Stay tuned to the next segment. We'll finish up with a few more thoughts on this. And of course, contact us at yourpersonalbank.com for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. We're rounding third. We're finishing up today. We've been talking a lot about on the Your Personal Bank Show today about annuities. And I know for a lot of people that's not necessarily a positive subject. But what I want to do is cut through the noise. And like I've been doing, if you haven't heard the previous segments, go back to yourpersonalbank.com. I highly encourage you to do so. I've been dealing with these for 22 plus years. I've been one of the top producers in the country with some of the top annuity companies in the country. I've also been involved with advisory boards where there's literally a handful of us with the chief actuary, product specialists, all that with the company creating some of these products. I understand these products in and out. Been dealing with them for over 20 years. There's all types of different annuities out there. There's variable, there's index, there's fixed, there's income annuities. I often find, and what I've been focusing on today is the income annuity side, because a slew of articles that have come out from Barron's, Kiplinger, you name it, talking about how, you really should look into an annuity for income instead of bonds. In fact, they're stating, instead of thinking retirement as stocks and bonds, start thinking about retirement as stocks and annuities. It's the guaranteed income portion that's the key on the income annuities. They're simple, the fees are very low, and they work. I've been dealing with them for, like I said, over 2 decades. For somebody that wants to ensure that, or they have a bond portfolio, and their purpose of that, or whatever their portfolio is, really, I should say, the purpose of that is to ensure an income, let's say, in retirement. The income annuity is something that should be looked at because it can create that type of income, oftentimes more than what the bonds would return, on a guaranteed basis. In other words, I always say this, folks, look, when we retire, we know we're going to we have a certain cost of living. We need food, we need shelter, we need clothes, right? There's a cost to those things, and that cost is different for everyone depending on their lifestyle. We know we're going to need that, and to put that known need at risk often doesn't make sense, does it? That's why the guaranteed income annuity can solve that. We can solve for that known need. So in other words, if somebody says, I need X amount of dollars per month, I just did this for a client this week. I need X amount of dollars per month at this age for retirement. We were able to reverse engineer it and say, look, this is how much you need to contribute in a lump sum or monthly for a period of time to accomplish that income need. Here's the beauty of it. It's guaranteed. There's no guesswork. I told you there's low fees involved. It's a very low-cost solution to accomplishing guaranteed lifetime income. That's what we're talking about, and that's what an income annuity does. That's its purpose. So if that's a need you have, contact us at yourpersonalbank.com. We can run the different companies. Like I said, you want to compare amongst a number of different companies because they pay different rates. They guarantee different amounts. You want to get the best rate you can get with a highly rated, A+ rated company, right? It's just that simple. This ensures you can supplement retirement income. It's setting up an income like a pension income or like a Social Security income, but you're doing it privately. You're doing it yourself, and you're ensuring that income is going to come in the rest of your life or whatever time period you choose. And also you can choose between you and your wife or you and your spouse, okay, for example, or husband. And the amount you're going to get per month, we can show you. All we need to know is how much you're going to need, or how much you can do it the other way. So I have this amount in my bond portfolio or in this bucket of money that I want to ensure income or create an income from. We can tell you, well, if you do this and you turn it on at this time frame, this is how much you're going to get per month. Again, there's no guesswork. This is not complicated. It's spreadsheets, basically. The computer figures it out, okay, and amongst a number of different companies. It really, really is an awesome option to look at for the person looking to supplement and guarantee income in the future, particularly for retirement or for the rest of your life. It helps ensure you don't run out of money in retirement. There's just a lot of benefits to this. And like I said, because it's based on a pool of insureds, it's a group. Even if the value of your account goes to zero, this is a common misconception I want to dispel. If the account goes to zero, you still get your monthly check. It doesn't matter. It's going to last guaranteed for the rest of your life. If you pass away prematurely, let's say you in 10 years it would have paid out what you contributed. So everything after that is gravy, right? It's all about guaranteed income. But you pass away in 5. Some people think that you're going to lose that money. There are options you can choose that do that. Most people don't choose that option. You can choose options where basically if you pass away prematurely, the principal, what you contributed, is either paid to you or the heirs. So the money isn't lost. So bottom line is this. You're creating a guaranteed lifetime income, one that you cannot outlive. You don't lose the principal. Either you or your heirs are going to receive the funds. We can set it up that way to make sure that happens. That guaranteed lifetime income can also be set up for you and your spouse's life, okay? There's differing amounts that you're going to be paid per month depending on which option you choose. We can explore those options. And again, you want to have an agent, an advisor who can show you the different options, fully understand the ramifications of those, and show you a comparison of a number of different companies, not just one, because you may or may not be getting the best rate. Okay? It's that simple. So don't let the articles or advisors who say annuities are bad or whatever dissuade you or influence you negatively towards looking at a tool, a financial tool that has literally helped millions of people. Literally billions of dollars of this is purchased yearly. Don't let anybody fool you. That's a fact. And it's a great solution, like all these articles are talking about, to ensure that you have income in retirement where bonds right now with the low interest rate environment may not accomplish. This is a way to guarantee it and ensure it actually happens. Again, that's why it's called guaranteed lifetime income. And you want a tool that maximizes that guaranteed lifetime income based on your situation, based on the amount you have to contribute, and based on your age. And based on when you start that income. You have total control of that, by the way. There's options you can choose where you turn it on, turn it off, adjust how much you get. It's entirely up to you. You can maintain control throughout the entire process of this. That's what's nice about it. If you have a pension or Social Security, those kinds of things, frankly, you really have little or no control on how much you receive, right? You get what you get. And if they adjust it, you get what you get. With a income annuity, you can maintain full control of how much you get, when it starts. You can adjust it up and down. stop and start it whenever you want, and ensure all the money you contribute goes to either you or your heirs. So like I said, I encourage you to check into this further. Contact us at yourpersonalbank.com, and let's show you how you can set up a guaranteed lifetime income that you cannot outlive.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.